Hey everyone, today I want to talk about a case study. So I put together a case study. It's really kind of a spreadsheet explaining my use of the options rental income system. I call it ORIS for short. But ORIS is a system that I developed. It's nothing necessarily novel or new. The base of it is a poor man's covered call, so it's really thinking about a poor man's covered call in kind of a new way a little bit, and then building some rules around it, rules for portfolio construction and for diversification and risk, to kind of essentially create a good alternative to doing things like AirBNB or Turo, where you rent out a home or a car and collect some income. So this is really, I'm kind of trying to analogize to that and came up with this system for essentially collecting rents on stocks, like good stocks that you'd want to own. And just you could essentially do this kind of forever. I mean, you could you're selling your upside on these stocks. So I want to talk about my experience with ORIS on a particular stock called IMAX. Now, this is kind of a small position of mine, but I think it illustrates ORIS well and the potential of ORIS. And I think it helps learn what it is and how it works better than me just trying to explain it without some visuals. So IMAX, you probably all know what IMAX is if you go to the movies at all, but it's kind of like a premium offering with a big screen. And so IMAX is a business. They actually make money from when you go to an IMAX movie at the box office, right? They've got, here's some of their big movies for the year. And as they as the movie theaters collect revenue, you have to pay an extra $2 or so for an IMAX movie. That usually goes to IMAX, so that's one way they make money. They also make money renting out their IMAX cameras and systems to movie studios that are actually making the movie, so they can film in the IMAX standard. And then they also lease like the projectors and equipment to movie theaters to display the films. So anyway, I won't get into the details, but it's a good business. I mean, they've got 1,600 screens in 87 countries, and it's about $1 billion enterprise value company. Probably generate about $100 million in free cash flow probably in 2024. So it's a pretty good business. I actually did a YouTube video on IMAX and kind of valuing IMAX a couple years ago, maybe not quite a couple of years ago. So I'll put a link to that in the description. But what I really want to get is talking about ORIS. So I have this website, syntheticyields.com. Check it out if you're interested, where I have this investing club where I provide some ORIS related education. Anyway, I have ideas on different stocks that I put out weekly, and so if you're interested in that, go check out the website. Now over to the main purpose. Sorry, wrong spreadsheet. Main purpose is this case study on ORIS. I just barely typed that here because I realized they didn't have a title. So this is my spreadsheet for my IMAX position. And if you're interested, I mean, if it would be helpful for me to make this spreadsheet available to you, or maybe even a template of it, then let me know. Maybe I can put something together. But this is just something I put together to track my position in IMAX. So it's really a poor man covered call position, and this looks like a lot of gobbledygook here and probably hard to understand. So let me try and walk you through it so you can understand it. And then I'll probably try and put a link to the spreadsheet so that you can take a look at it, at least. So initially, these two lines here, I put on a poor man's covered call on IMAX. So poor man's covered calls, you buy a Leaps call. I do deep in the money. So it's really a proxy for 100 shares of stock because your delta is pretty high, usually around 85 is what I advocate. 85 delta, meaning it has exposure about 85 shares. So not quite 100. And then I sell an at the money call. So I sold this May 20th 15 strike call. At the time, the stock was trading right at 15 bucks. So it was truly at the money. And I also, a few days later, I bought 5 shares of stock for $16.39 is this third line. And then this fourth line is I also, the same day I put on this poor man's covered call, I also put on a butterfly put, a put butterfly as a hedge. And that would cause my break-even price to go even lower on the stocks. I often do that. It's kind of part of my ORIS system, especially on my initial trade. In this environment where stocks just seem to go down every day, I'll usually put on a hedge, at least on that initial trade. And so really when it comes down to it, the amount of capital I put at risk was about, I have it up here, about $758. Not a huge investment, right? $758 investment. Now, of course, you could always scale that up by having more than one contract. But that's just an aside for those who have bigger accounts. And it's not a huge part of my portfolio. Part of ORIS is, there's rules. One of the rules is to keep 50% of your account in cash at all times, which is important. If positions go against you and you need to adjust them, you'll need cash to do that. And so always keep 50% of your cash or your account in cash at all times. The other one is diversification. So, I wouldn't advocate putting more than 10% of your portfolio in any position. And if you have a big enough account, I would strive to not put more than 5% of your account in any one position, so that if a position goes against you, it's not the end of the world, right? Even if it went to zero, it wouldn't be the end of the world. Okay, so getting into this, the important columns that I want you to pay attention to are these two columns, which relate to this column, and this column here. So the important thing to note is that we are essentially sellers of opportunity and time, I guess is what you could say. So when we sell this $15 strike call, this May 20th $15 strike call, we're selling somebody the upside above $15 for 30 days approximately. And that person pays us $97. So we got a credit of $97. Of that $97, since the stock was right at the money, same price as our strike price, there was no intrinsic value. Intrinsic value is when the stock price is above your strike price. There's zero in this case. So all of the value, all of that $97 was extrinsic value. And that extrinsic or time value, is another name for it, is time value, is the rent that we collect. So somebody paid us $97 for the upside for 30 days, right? And so that's the rent we collected, and that's what I noted here in highlighted in green, because that's what we collected. Now, I mentioned I spent $16 of that, in essence, to put on a hedge, so I'm subtracting out $16, but I spent $16 of my rental income for that. And now let's go down to these two lines. So when May 20th arrived, which is the expiration date of the May 20th call, we rolled that May 20th call. So I bought it back for $64. Now, why $64? Well, at the time, the stock had gone up to $15.59. And so I had to pay $64 to buy back the $15 strike call. And of that $64, 59 of it was intrinsic value, because that call was in the money now. by 59 cents. And so that means the remaining $5 of the 64 was time value. So I still had to buy back some of the time value. That's why I'm showing here I'm spending $5 of rent for that $5 of time value I had to buy back. The intrinsic value is kind of a non-factor when you're selling the same, when you're rolling the same strike, because this June 17th call that I am selling, this still a $15 strike, that June 17th call, I sold it for $134, right? So I sold that June 17th for $134, bought the May call back for $64, right? Of that $134, 59 was intrinsic because it was in the money by 59 cents. And that means 75 of the 134 was time value. And so somebody paid us $75 worth of time value for this $15 call that expires on June 17th, which was approximately a little shy of 30 days from the date that we did this. And so that's another, this time value is the rent we collect, right? So that's why I put $75 here. We collected another $75. But of that, we spent 5 of it we had to kind of buy back the May 20th one, because there's always a little bit of time value even on the last day of the option, because there's maybe a few hours for the stock to still move up or down. So there's always like time value all the way up until the last couple minutes. Anyway, and then we fast forward another month. So when June 17th arrived and that June 17th call was expiring, I rolled again. So the stock had gone down to $15.19. I bought back that call. Remember, we sold it originally for $134. I bought it back for $24. Of that, 19 was intrinsic, $5 was extrinsic. Right? And then I simultaneously sold the July 15th for $106. Of that $106, $19 was intrinsic, right? Because it was trading 19 cents above my strike of 15 times 100, because the option contract is for 100 shares. and so 19 was intrinsic, $87 was time value, right? So whoever bought this call was paying us $87 of time value for, the upside above 15 for the next roughly 30 days, right, to July 15th. So that's why the 87 of time value is what I put here as the rent I collect. And just note, so the time value, when you're a seller of an option, you will always, I mean always, as long as time moves in the forward direction, you will always collect that time value, because that will decrease, that will trend to zero. So by expiration, it should be, at expiration, the minute of expiration, it'll be zero. Like I said, we can never really get to 0. It's like we'll buy it back for $5 because still, a few hours left in the day. But anyway, so the time value component of your option will always go to 0. So you always get to pocket that time value. And so really with ORIS, where we're doing these deep in the money, poor man's covered calls, the losses don't come from your short calls. Well, I guess I should caveat that with generally, okay? You got to have, if the stock rocketed and you didn't have, anyway, that's a long story, but generally speaking, I won't get into it. But so if the stock goes down, you will lose money overall if the value of your leaps call, so remember this leaps call we bought up here for $757, if the value of that call goes down more than all the collective rent we collect, then that's where you would have some losses. Now, we've been able to collect some nice rents over the last 2.5 months. It's just been, over 70 days or so. And you can see I totaled up here, we've collected $214 of rent. I forgot the last, so the last roll actually is this one here. So I actually closed the July 15th one, I think last Friday. I sold the August 19th for $199, bought back the July 15th for $139. And why did I have to pay so much for the July 15th one? Because the stock had risen quite a bit. It went up to $16.20. So it was $120 in the money, right? So that my intrinsic value I had to buy back was $120. I bought back about $19 of extrinsic value. Remember, I sold about 87 here, right? But the one I sold for $199, the August one, you know, $120 of it was intrinsic, so that offset the intrinsic we had to buy back. And then I sold, of that $199, 79 was time value. Right, so I collected $79 of time value. I didn't put it here yet because I haven't closed it yet, right? It's still open. So when it closes, I put it here, and that would bump up the total rents that I've collected. So I can kind of project, and that's what I do here in this side here. I'm projecting, you know, net, because I had to spend $19 of time value to buy back the July call. Once I close out the August call, as long as time keeps ticking by, I'll collect roughly net $60 of rent, because this I would have a $79 of rent here. Net I collected 60, yeah, so that would be 293. So that would say it showed 293 here as well. So that's how much rent I collected, right? But to get the net profit loss at this moment in time, I would have to add back the change in the time value on my leaps call, on that long call, this first line here, right? So you can see initially I bought that $8 strike for $7.57 when the stock price was at 15. So I really had $57 of time value that I was paying for that. And as I mentioned, now as a buyer, the time value kind of cuts against me, and it's kind of it's a headwind, not a tailwind when I'm a buyer. And so now the time value, today this option is worth $840, but the time value piece of it is only 38. So I've lost about $19 of time value on this leaps call. So I got to subtract out that $19. And then the stock, the $5 of shares that I bought here, right? I bought them for $16.39. The price is slightly lower. So here, the value of the stock's about $80.10. I've lost $1.85. So I've got to subtract out the $1.85. And then here, you also got to subtract or add back the change in the short call time value. So, which is the latest one. So this August 19th call, right now it's worth $180. I sold it for $199, but the time value piece is $78. It was $79 originally, so I've made $1 in time value, and that's really the rent I collect. So I add that back. I made about $1 on that so far in the last few days. So the net profit loss is $194 as of today, the 12th, right? So that's one way of calculating the profit loss, is just looking at the time value that you're collecting and then making these adjustments for the changes in time value and the change in stock here, right? That's one way. There's a second way, which I've diagrammed here. This is the same profit loss. You can also look at it from kind of like a balance sheet perspective plus cash flow. So your assets, I've got this $840 leaps call that I own. I've got $80 of stock, so I add those two together. But then I've also got liabilities, because I've got to buy back that short call at some point. Right now it's for $180 of liability, because that's what it's worth right now today. So I've got that liability I got to subtract out. And then I got to add my net cash flow. So that comes from these columns here of the incoming and outgoing cash, and then this is the net cash flow. It's kind of like a cash flow statement almost. And so, I've collected about $536. I've spent, because I did a big initial outlay at the beginning, right? So I spent about $1,081. So net, I've still, negative $545 of cash spent. So when you take the value of the assets minus liabilities plus or minus the net cash flow, you get to the same answer. So it's just another way of getting to the same result of what your profit loss is. So interesting thought experiment. So if you look at the profit and loss, right, $194.15. That is, really from this one, approximately $750 investment, I have been able to generate about a 25% return. And so that almost $200, so far over 2.5 months, that would more than pay for going to the movies every month with my family, and I've got a fairly big family, right? I could even spring and go to an IMAX movie with my family with the rents that I've been collecting over here, and in theory, right, I could do this every month. Now, this is a bit of an anomaly. I'm making about a 9 to 10% return on the capital invested up here every month, and you can see that the ROC is high for 2.5 months, and the annualized return is very high, 130%. Now, I wouldn't say this is the norm. Okay, this is been a good position. I've got some positions that are lower ROC, lower annualized return. I've got some that are actually negative because the stock has plummeted. The market's been a tough market, right? So your overall portfolio is not, I would not expect this from every position in your portfolio. But it's interesting, just to see that really this is real income that you're generating from your position. And you could, in theory, continue to do this ad infinitum. You would eventually, coming up here pretty soon, probably this month, I will roll this Leaps call out to, so it's got about a year left. I don't, if there's less than 6 months left, then that's a signal to me to roll it, because I want that Leaps call to always have at least about 6 months left before expiration. So I'll have to pay a little bit to roll that out, 6 months or more. But I could continue to do this, continue to collect rents, and over time, it should be a good investment for me. Now, I personally try and target about a 30% annualized return, which is 2.5% per month. And I think that is doable. Here, we've been able to collect these rents because the stock price has hovered around that initial $15 strike price. And when that happens, that's when you make the most money, is when it hovers around where your strike price is. Now, if the stock moves up substantially or down substantially, then the rents that you collect will go down, because the further away from your the further the stock price is away from your strike price, either up or down, the less time value you collect each month. I actually looked at this before this video. If I was down $3 from the strike price, I believe, so if the stock price was down around 12, I would collect about 25 bucks a month. Or if it was in the money by $3, so if the stock price was around $18, so $3 above my $15 strike, I would be able to collect about $25 a time value on the $15 strike. So that's still about a 2.5% yield on the capital invested, if I collected $20 or $25 a month. And so I probably, just continue to do that. You know, if the stock moved in that direction, you know, either up or down, $3, instead of collecting 60, 80, 70 bucks a month, I would be collecting 20, 25 bucks a month. So anyway, love to chat with you more about this. Feel free to join the Discord. You can ask questions there. There is a free version. I've gone way too long, so I'm going to cut this video off now. But there's a lot to learn here. I'm still learning every day from my trades. So I'd love to talk about this. And if you have questions, you can also list them in the comments to this video. All right, thanks. Bye.